Hello traders, the title of the video is how to become a more advanced Elliott wave trader. Part 2. We highly recommend to traders to watch part 1 and also watch part 2 so they may become a more advanced Elliott wave traders. In the first part, we were talking about corrective wave, how one can become a more advanced Elliott wave trader, analyzing corrective wave. So I was using this example here when you see the price came down 1, 2, 3, 4, 5, but the fourth wave is overlapping the first wave, and we have a complex correction. This is the first part of the correction, this is the second part of the correction, and the third part of the correction is subdivided into 3. So because we are Elliott wave traders, sometimes we get confused because of the 13 specific Elliott wave pattern. We are wondering what kind of pattern is this one. And sometimes we get confused because we forget about interpreting the language of the price, and we are focusing more on the price. We are focusing more on the Elliott wave pattern. There's nothing wrong with that. We can focus on Elliott wave pattern, but the first thing that we need to give priority to is the interpretation of the price action. Very, very important. It's so that we may avoid a confusion that usually arises when we are using the Elliott wave patterns. All right. So in this second part, I want to talk about another price structure. All right. So if you have been trading for some time, or you are using technical indicators like a stochastic MACD, RSI, CCI, you will notice that the default setting for those technical indicators is usually 14. I have recorded a video about that in the past when I explained to traders why they use period 14 for the default setting. Now, for Elliott wave traders, there is another reason why they use the period 14. It has something to do with the interpretation of the price structure. All right? The interpretation of the price action, and also something to do with the minimum price move is free. So I have a drawing on my chart. I want you to concentrate on my blue drawing. I have too many lines on my chart. Let me remove some of them, and we'll start talking about how to become a more advanced Elliott wave traders. So what I was saying to traders is that anytime you count first and second wave is to highlight those two waves with two vertical lines. That's what we said in the first part of this series of video, how to become a more advanced Elliott wave trader. Yes or no? All right. So pay attention to my drawing here, and you'll notice here. So suppose you were here. You see, if I went up 1, 2, 3, 4, 5. And then you pull back again, and then 1, 2, 3, 4, 5. Yes or no? So if you call this one 1, 2, 3, 4, 5, and if this session talking about the corrective wave, generally speaking, is subdivided into 3, you'll be counting 1, 2, 3, 4, 5. 1, 2, 3, that's 8 in total. So 1, 2, 3, 4, 5, 6, 7, 8. And then we have again 1, 2, 3, 4, 5. So from here all the way up here, we have 13 specific waves. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, and 13. So you can see that the first move, don't get confused. Stay with me, please. Stay with me because it's so important. That will help you to avoid. So you count 1, 2, 3, 4, 5 to here. So that's 5. 1, 2, 3. That's the correction. And then you have 1, 2, 3, 4, 5. So in fact, we have three waves. The first wave subdivided into 5, the second wave subdivided into 3, and the third wave subdivided into 5. But from here all the way up here, we have 13 waves. Now, using what we call the market stable data, what we call something that is true in the financial market, all right, the minimum price move is 3. So once you see 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, you will say we have 3 moves. If the price pull back like this, you will say that is a high chance that the price may come down, because you say that minimum price move is 3. And then you say that the price is likely to come down here at this point in time. It's normal to expect that the price is likely to go down because of the market stable data that stated that the minimum price move is 3. Now remember what I was saying to you about the default set in 14. So Elliott wave traders, referring to Elliott wave traders, 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, all together we have 13 waves. So this is again one of the reasons why they use the default setting 14. 14 in the financial market. It is working beautifully, as you can see. Most of the time it's working beautifully. And I explained to trader before why we use the period 14, all right, talking about multiple time frame trading method, all right, and what is the best time frame to use the period 14. We talked about it before. I don't want to dwell on that. And this is another reason. At the end of 13 waves, we will expect a kind of a pullback. The price has a high chance after 13 moves up, 1, 2, 3, 1, 2, 3, 1, 2, 3, 4, 5, has a high chance to pull back after that. There will be a pause after we have counted a 13 specific wave. So now, sometimes Elliott wave traders, ordinary Elliott wave traders, get into trouble. Elliott wave traders that are not advanced traders get into trouble because they do not know how to interpret the language of the price. Take it from me. In order to interpret the language of the price more accurately, one should understand two things. All right. When we count 1, 2, 3, 4, 5, the first thing that is coming to our mind is a multi-wave. Now, after further verification, if, for instance, the third wave is not the shortest multi-wave, or the fourth wave is overlapping the first wave, or if the second wave has cancelled the first wave, we will not think of a multi-wave, yes or no? All right. So sometimes Elliott wave traders, they will count waves like this, especially those who are using the zigzag pattern, because the structure of the zigzag pattern is one example that usually confuse traders. So you see, the structure of the internal waves of the zigzag pattern, we have 1, 2, 3, 4, 5, yes or no? And then 1, 2, 3. And again, 1, 2, 3, 4, 5. But those 1, 2, 3, 4, 5, those sub-waves can overlap. So then we know quickly that this is a corrective wave because a zigzag pattern, those 1, 2, 3, 4, 5 can overlap. Those waves can overlap because they are not multi-wave, they are corrective wave. That's the only reason how we know. But sometimes, take it from me, you may see a zigzag pattern when you may see 1, 2, 3, 4, 5. When those first subwaves are not overlapping at all, there is no Elliott wave violation at all. So you will have a clear cut 1, 2, 3, 4, 5 as a drawing on the chart. So you'll be thinking of a multi-wave. And then you have 1, 2, 3. Then you say, all right, we are going to have a trend, which is okay because you see 1, 2, 3, 4, 5, no overlapping, no Elliott wave violation, 1, 2, 3. You expect another move up, continuation. Now, and then you see again anotherly 1, 2, 3, 4, 5 when those subwaves are not overlapping. So, but at that point in time, you are thinking of what? A trend in first because you see 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, and no Elliott wave violation. So you will say that probably the trend will continue. But sometimes you may see a zigzag pattern that is exactly that, which means you see 1, 2, 3, 4, 5, no overlapping, no Elliott wave violation, 1, 2, 3, 1, 2, 3, 4, 5, and no Elliott wave violation. But from here all the way here can be just a zigzag pattern. Why? Because the market stable data is more important than anything else in the financial market. The reason why we can have a zigzag pattern where the internal wave of the A part of the zigzag pattern are not overlapping, and the internal wave or the C wave of the zigzag pattern are not overlapping, is because of the behavior of market participants. Though one may quickly think of a trend, there is no trend because all we do care about the minimum price is free. 1, 2, 3, 4, 5, no overlapping, no area of violation. 1, 2, 3, 1, 2, 3, 4, 5, no area of violation. But the most important thing, though we are thinking that there may be a continuation, we should acknowledge the fact that there is a market stable data that stated that the minimum price move is free. So you may wonder, say, Joe, what are you talking about? Here it comes, my friend. Sometimes traders get into trouble when they are counting waves. All right. One example, which I already told you, is the zigzag pattern. So you see price coming down 1, 2, 3, 4, 5, no area wave violation. 1, 2, 3, and then again 1, 2, 3, 4, 5, no area wave violation. So you see first wave, second wave, third wave. And you are expecting the fourth wave and a fifth wave. But if you forget the minimum price move is free, the market stable data that is superior to the anything else in the financial market, you will quickly get into trouble. So what is happening? All right. So when we count 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, we will say as long as the price, if there is no area wave violation, we'll say that there is a high probability that the price will break above this high. But if the price fails to go above that high, we will refer to the market stable data that the minimum price move is free, and we won't be surprised that the price is coming down, forming a clear-cut correction, even coming back to the beginning of this move. But when you were here, you will think that this is the first wave, this is the second wave, this is the third wave, because there was no area wave violation. But then, as this move is going down, you will think that it's going to have your fourth wave, followed by the fifth wave. So what I will say to traders at this junction, in order to become a more advanced area wave trader, when we count 1, 2, 3, 4, 5 waves without any area wave violation, it is okay to call that wave an impulse wave. But we don't want to forget that, okay, anything is possible. Now, if the price pull back without coming to the beginning of the first 1, 2, 3, 4, 5, all right, we will say that, okay, there is a high chance that we will expect another multi-wave. So here it comes again, 1, 2, 3, 4, 5, no area wave violation. So we will say that, all right, there is a high chance that the trend will continue. There's a high chance we may have a trend. But if we forget that that trend will not take place, if the price fails to go above this high, we can quickly misinterpret or misuse the area wave principle. What I have suggested to traders is that whenever we count first and second wave, we need to put two vertical lines to highlight those two waves, because the first and the second wave, whether in a corrective wave or a multi-wave, will help us to forecast what is likely to take place. I told traders in the first part of this tutorial that the identity of any trend, if there will be a trend, is always in the direction of the first move. So we know also that the minimum price move is free. So when we see first and second, we draw the line. So suppose you are here, all right? Suppose you are here, so we come first and second. Suppose this first is subdivided into 5. So 1, 2, 3, 4, 5. Followed by this one. And this one did not come to the beginning of this one. What can you deduct from that as an area way, as a more advanced area way trader? So you will say to somebody and say, looking at the structure of the first move, 1, 2, 3, 4, 5, is an impulse move. There's a high chance that we may have a bullish trend. Why? Because after the second wave did not come to the beginning of this one, you know that the identity of a trend is always in the direction of the first move. Because the first move is bullish and it's an impulse wave, we are likely to see a trend. So you will be expecting a trend here. So in order to avoid area wave trading mistake, after you have identified first and second, I hope I'm trying to communicate what I'm trying to, how should I put it to you? I hope I'm communicating exactly what I'm trying to communicate to you. All right. So after the first and the second, we will put two vertical lines there. And then we'll restart analyzing the price structure after the first and the second one here. So here we say there will be a trend. There is a high chance we may have a trend. This is an impulse wave. Second wave did not cancel the first wave because the first wave is bullish. There is a high chance that the next move after the second move will be up. For sure, it will be up. If you were here, you see this one come down first and the second, you highlight the first and the second. You can deduct that definitely if the price fell to go above this high here, the direction of the price will be down. Why? Because the identity of the trend is always in the direction of the first move. So here you'll be saying the direction of the trend is likely to be up because the first wave is up. So now, as we count the first and the second wave, in order to avoid Elliott wave trading mistake and to become a more advanced trader, we will now put those two vertical lines and start monitoring or trying to interpret the language of the price after the first and the second wave. This will help you to avoid all kind of mistake. And you want to do that, very, very important point here, in conjunction with the minimum price move is free. So if you see 1, 2, 3, 4, 5, and then a pullback. If there is no Elliott wave violation here, you will say after the second wave that there will be a trend because this is an impulse move. And we have a correction that did not come to the beginning of an impulse move. So we will expect the next wave to be also an impulse move because the first move, wave, if the first wave is an impulse move, we will expect the third move to be an impulse move, yes or no? But if you fail to highlight the first and the second wave, you can quickly get into trouble because anything is possible after the first and a second wave. By doing so, you will avoid all kind of confusion when you are using the Elliott wave principle. Most importantly, if you start paying attention to the interpretation of the price, minimum price move is free, all right? Free refer to corrective wave, fire refer to impulse wave. As long as there is no Elliott wave violation, you will start becoming a more advanced Elliott wave trader. So you may see 1, 2, 3, 4, 5, 1, 2, 3. Highlight those first two waves. Good. So suppose you were here. So you may say, Joe, well, how about here? So you were here. You see first wave. I want to dwell on this a bit more. So some traders already understood this, but I want to dwell on it a bit more for traders that are behind. Okay. So suppose you are here. See first and second. So you highlight them. All right. So you will be saying there is a. So you may say it's true in all cases. So you see. Okay, first and second. Okay, so you may say, all right, because the first is bullish, there's a high chance that the third move will be also bullish. It's true in all cases because the minimum price move is free. The direction is always in the direction of the first wave. The direction of a trend is always the direction of the first move. So even if you are here, suppose you are here, you see, first and second. Now, you can see that the second one did not come to the beginning of the first one. So what's going through your mind? What can you predict? You say that the next move will be up. Yes or no? You can say that. Now, if you just expect, because this one is quite tall, you may say impulse wave, second wave, you're expecting a third wave. If you do not, this is what I'm talking about, if you do not highlight the first and the second, and you start paying attention to the structure of the price action after the first and the second move, you can make all kind of wrong prediction, all kind of wrong forecast, all kind of wrong decision. You can see that if you call this one first and a second, you're expecting a third move. You can only predict the direction of the third move, but you can have a bit of idea. You can say that, all right, because the first one is impulse, therefore the third will be impulse. But it's just a deduction until the price confirms your deduction. So sometimes Elliott wave traders that are dealing with a zigzag pattern may see a zigzag pattern where they see 1, 2, 3, 4, 5, no Elliott wave violation. 1, 2, 3, again here. So you are here. You are saying, well, all right, it looks like a trend. Then you see 1, 2, 3, 4, 5. Now you are thinking of your fourth wave and the fifth wave. But then surprise, surprise, the price came down and crashing all the way here. You are saying, well, this is an impulse wave, this is a corrective wave, this is an impulse wave. Why we do not have another fourth wave followed by the fifth wave? 5 and 3. 1 and 2. Can you remember that? 5 and 3. 1 and 2. So when you count 1, 2, 3, 4, 5, check the structure of the price. Is it overlapping? Is it an impulse? Okay. If they are not overlapping, you will think of an impulse wave. Good. So this is about 5. You will, if you call 1, 2, 3, the first thing that is coming to your mind, whether it's here like this, you see 1, 2, 3, 4, 5, 1, 2, 3, 1, 2, 3, 4, 5, no area with violation, no area with violation. Remember this, anytime you see 3 like this or even overlapping, you will think of what? Correction. Good. You will pause first. Alright? So 5 and 3. The next thing that I'm bringing into it today is 1 and 2. Remember, the direction of the price move is always in alignment with the first move, wherever you take it from. Is it making sense? These are powerful things you can work with in the financial market. So now by doing so, you are using the area wave principle, but you are giving precedence to the interpretation of the price action. So again here you say first move, second move. Second move did not cancel the first move. High chance that the third move will be in the direction of the first move. But remember 5 and 3. Remember 1 and 2. Because of the 1 and 2, you place a 2 vertical line anytime you count 1 and 2. And then from that, you start analyzing the next move in all cases. So this is one example here. When a zigzag pattern, we don't see the A part of the zigzag pattern, no overlapping, no area with violation, 1, 2, 3. Again, C part of the zigzag pattern, 1, 2, 3, 4, 5, no area with violation, looking clearly like an impulse wave, but because of the minimum price move is free, don't be surprised that you may see a correction after that or a reversal after a zigzag pattern or a bounce up or a next wave. Have I been repeating myself too much? Am I stressing on it too much? All right, traders that are more advanced already get a message. So 5 and 3, 1, 2, 3, very, very important. Correction, first thing coming to your mind, minimum price move is free. 1, 2, 3, 4, 5, impulse, check. Is there any area with violation? No, impulse. But most importantly, the structure, the interpretation of the price action is more important than the wave pattern. By doing so, you'll be able to recognize clearly the area wave pattern. So here, as you see your zigzag pattern, 1, 2, 3, 4, 5, 1, 2, 3, 4, 5, no area wave violation. So you say, all right, it looks like a trend. Normally, we should expect an overlapping. And then 1, 2, 3. And the third one also, 1, 2, 3, 4, 5, no area wave violation. Now you are thinking, yeah, those are impulse waves. All right, it looks like we'll have a continuation. But if you forget the interpretation of the price, minimum price is free, here you surprise, surprise, the price may come back down. So when we look at the multi-wave, you remember the normal multi-wave, all right, remember this, the normal multi-wave we have, the first wave can be subdivided into 5 waves, no violation of area wave principle. Second wave can be subdivided into 3, no area wave violation. Third wave can be subdivided into 5, no area wave violation. Fourth wave can be subdivided into 3, again. And then we have the fifth wave also can be subdivided into 5. So that's why we can use the structure of the first wave to focus the multi-wave. And we can use the structure of the second wave to focus the corrective wave. So in all cases, 1 and 2, draw the 2 vertical lines. Those will help you to focus the price action and to have a bit of idea what is happening. It can also help you, that 1 and 2 will also help you to avoid area wave confusion. So you were here, 1 and 2, put those 2 vertical lines there. All right. Make your deduction that the term is likely to be up because of the first move. But if you do that and you analyze the price move after the 1 and 2, you are likely to see clearly what is happening here. This is 1 and 2, followed by the third one that is subdivided into 3. And then again, you count. So you may go and say, all right, that is 1, 2, 3, 4, 5. Anytime you see 5, check if there is an Elliott wave violation. So 5, check Elliott wave violation. 3, think of correction. 5, think of impulse wave. Remember that we have 13 specific Elliott wave pattern, but those pattern, the interpretation of the price action is superior to the Elliott wave pattern. This will help you to become a more advanced Elliott wave trader. That's enough for me. I hope I have managed to communicate what I'm trying to share with traders today. And I hope that will help traders to start focusing the market, predicting the next price action, recognizing clearly the price structure, because sometimes they become 1, 2, 3, 4, 5, 6, 7. And then the price change direction. People say, what structure is this? We do not have 1, 2, 3, 4, 5, 7. What's going on? Or trader may count 1, 2, 3, 4, 5, 6, up to 13. What kind of price structure is this? We don't have a pattern like this. But if you do 1 and 2, and you remember 3 and 5, you'll be able to decipher, to dissect the price structure and be able to make excellent Elliott wave decision. As always, if you have any question or suggestion, put in the comment section, and in due course, I will be recording another video to answer your specific question. This will conclude our discussion today about how to become a more advanced wave trader part 2. If you like the video, give us the thumbs up. If you think that is another blah blah blah, mark it down. If you think it's an essential tutorial, feel free to share with your friend on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders, talking about how to become a more advanced Elliott wave trader, part 2. Happy trading to you all, and speak to you soon. So this is the end of this series of videos. So I don't know, I'm not going to record a part 3 or part 4 or part 5. So this is it, part 1 and part 2, how to become a more advanced Elliott wave trader. I really encourage traders, if you have any question, you watch the video, the full name for this video. Do not watch part of it and ask a question, because probably I have already answered the question. Watch the full name for the video, and then put your questions at the end in the comment section. I always read the comment, and in due course I will record another video to answer your specific question. Thank you for watching, and speak to you soon.